Welcome to Dime Dive. Ever jumped on an investment trend just to see it nosedive faster than a lead balloon? Congratulations, you might just be an investor. Welcome to the grand spectacle of the Investing Circus. Here, high-wire acts represent the latest investment fads, enticing with their flashy performances, only to tumble down in a heart-stopping finale. The clowns? They're the hyped-up stocks, promising belly laughs and riches, but often leaving you with nothing more than an empty wallet and a pie in the face. And those daring acrobats flipping through the air? They're the actively managed funds, charging high for their daring feats, but often falling short of the mark. The stock market, ladies and gentlemen, is a circus, a chaotic, unpredictable, high-risk extravaganza. And while it's exhilarating to watch, remember the performers are professionals. They've trained for years to perfect their acts. Just like a circus, it's fun to watch, but do you really want to be the one walking the tightrope? Remember the fable of the tortoise and the hare? Yeah, investing isn't like that. It's more like the tortoise and the index fund. Gather around, ladies and gentlemen. The hare, with its quick hops and bursts of speed, represents active investing. It's flashy, it's exciting, it promises big returns in a short time. But it's also unpredictable, often leading to losses as quickly as gains. And let's not forget, the hare tends to get tired easily, just like the returns from active investing can fizzle out. On the other hand, the tortoise, slow and steady, embodies the essence of passive investing or index funds. It might not be as glamorous as the hare's high-speed sprints, but it's consistent, reliable, and most importantly, it gets you to the finish line. The magic of index funds lies in their simplicity. They're designed to mimic the performance of a specific market index, like the S&P 500, giving investors broad market exposure at a fraction of the cost of active funds. And over time, thanks to the power of compounding, these steady returns can add up to significant wealth. In the world of investing, being the hare might seem tempting with its promise of quick riches, but remember, it's the tortoise that wins the race. It's the tortoise that keeps moving forward, unfazed by the market's ups and downs. So, if you don't want to end up like the hare, out of breath and out of cash, maybe it's time to consider the tortoise's way, or should we say the index fund's way. Ever tried running a marathon without training? That's what investing without a plan feels like. Imagine yourself on the starting line of a marathon. The atmosphere is electric, adrenaline pumping, your heart pounding like a drum. Now, imagine yourself trying to sprint the entire distance. Sounds ridiculous, right? That's because it is. Just as in a marathon, investing requires patience, discipline, and a well-thought-out plan. Think of your investment strategy as your training regimen. It's what prepares you for the long haul, helps you set the pace, and guides you towards the finish line. This is where the principles of asset allocation and risk management come into play. These are your running shoes and your hydration pack, providing balance and protection, ensuring you don't stumble and fall. Just as every marathoner knows the peril of starting too fast, investors too should be wary of the lure of short-term trends. It's easy to get swept up in the excitement, the promise of quick gains. But remember, the market is a fickle beast, as unpredictable as the weather on race day. Trying to time the market is like trying to predict a thunderstorm in the middle of a desert. You're more likely to get sunburnt than wet. Resilience, too, is key. There will be hills to climb, muscles will ache, the finish line may seem impossibly far. But remember, the journey of 1,000 miles begins with a single step. So remember, investing isn't a sprint, it's a marathon. And just like in a marathon, the ones who start sprinting too early are usually the ones who don't make it to the finish line. Ever bought something only to find out there's a hidden fee? Welcome to the world of investing. It's like buying a car, only to find out you also have to pay for the steering wheel separately. In investing, these steering wheels come in the form of expense ratios and transaction costs. Just imagine you're buying a dozen apples, but when you get to the checkout, you find out you've been charged for 13. That extra apple, that's the hidden cost of investing. And while it may not seem like much, over time, it adds up. Like a leaky faucet, those small, unnoticed drips can fill an entire bathtub. That's why it's crucial to keep an eye on the small print and minimize expenses whenever you can. After all, why pay for 13 apples when you only want a dozen? So next time you're eyeing that shiny new fund, remember to check the price tag. Because in investing, the devil is often in the details, and those details can cost you a lot. Ever heard the saying, common sense is not so common? Well, in investing, it's even less common than you'd think. Listen, y'all, you're not trying to outrun the market. Instead, you're the tortoise, slowly but surely investing in low-cost index funds. You're not the hare, chasing every market trend. You're the marathon runner, thinking long-term. And those hidden costs, you've got them under control. So remember, investing might seem like a circus, but with a little common sense, or should we say uncommon sense, you can avoid becoming the clown. Subscribe to Dime Dive